It's Rav. You're watching The Everyday Investor, the hottest real estate investment show in the world. That's right, I said it. I don't care who knows it. I'm so excited about the show because it's always a pleasure to be able to have the mortgage specialist extraordinaire, investor, teacher, good friend, Carmen Capernero on the show. We're going to be talking about a lot of things on the show. We're going to be talking about investing in mortgages, investing in private, investing in group, otherwise known as syndicate mortgages. We're going to be talking to a landowner. So if you are sitting on some land and you want to know what perhaps we can do to that to maximize your return on investment, we're going to be talking to Matthew. He's on the show. We're going to be talking to a development arm of the mortgage product. We're going to be talking about Valor Capital and how they assist in the mortgage play and how we can invest our money in development. Lots of good stuff. Remember, whenever you're introduced to an investment product, you always want to ask 4 questions. What's the return on my investment? Number 2, when do I get that return? Number 3, what's the minimum cash amount needed? And number 4, what is the risk? Carmen, it is so wonderful to have you here.
Great, thanks you.
Thanks for being here on the show. And I get to talk to you weekly.
Yes.
And you get to share some wonderful pieces of wisdom in terms of the whole mortgage world, and more importantly, how people can make money, invest it, get some cash flow, so that they have more time to be able to do what they want, when they want, with whom they want. And that's what I appreciate most about you. Is I say it every time you come on the show, but it's you always nurture me, inspire me. I learn from you about the most important currency we have, which is time to be able to spend with family and friends. And
I agree.
So how are things going? It just seems like life is going by so fast.
Summer.
Absolutely.
Wasn't it just summer? Now look where we are. Unbelievable.
It's going by so fast, but what are you doing? Talk a little bit about the philosophy. I want the people at home to know your thoughts around investing in real estate and being able to allow that to enjoy the life that we can enjoy.
Well, my theory, my model is always time. I stop at pretty much 5 or 6 every day.
It's amazing.
And every weekend is my time.
Yeah.
So I don't even want to talk. I don't do business on the weekends. I don't turn on my phone. Occasionally, if there's something urgent, I do. Yeah. But I need that time to be with my family and have peace of mind.
And you're only better to your investors, your clients, when you're able to do that. When you're able to take some time off to build margin in your life. When you come back, now you have 100% to be able to give to those that
and
you're
there's
serving.
always going to be everything's an emergency in life.
Yeah.
So if you don't say stop, this is for me now, your whole life will pass you by, and you've never done that.
Yeah.
So that's what I believe in.
And you've been investing as young as you look. You've been investing for a few decades now. I think your first property was in your late teens, and you were able to clear 6 figures on that property. I think that's always a great, great story to hear. And then from there, you've went on. But actually, one of our guests today, a landowner, but I've known him for a long time. But I didn't make the connection between Matthew and yourself. So tell us a little bit quick, when you first got started, and how
I'll be really
Matthew was influential in
Well, when I started many years ago, I was working out of my basement, and many people have heard the story, but literally there was a washer and a dryer in my office, which was my basement, in a very modest home, my fold-out table and my fax machine, and I had an ad in a local newspaper for Hamilton, so it was Hamilton Spectator, and Matthew responded to my ad, and I've told the story a few times because it's interesting how it just kind of, I was fortunate and it just landed on my lap. Yeah. And I responded to his ad, and it was not the best mortgage to get, and I worked very hard to get it done, and I got it done. And then he was so happy about that he put it on the overhead projector, and he happened to be a head speaker to an investment training company where he spoke to 150 people a month. Amazing. And he said, Carmen, and I went, what? And then all of a sudden all these calls were coming in, and I went, wow, what is that? And I was determined to get it done, even though it wasn't the best and most appealing and high paying deal, but I got it done. And then it led to this wonderful opportunity. So he's the guy that started this all really for me.
Very
Made it land in my lap, so it was amazing.
Sean Matthew Fredericks.
Sean Matthew
Fredericks.
Yes,
I've had him, I think a few years ago. He came on the show, and we would talk about different types of things. And so it's very cool. So he owns a piece of property. Yeah. He owns some land. And he may do some development on that, and he may use investors that you know and that trust you. And we're going to see how all that kind of works together.
So a start to finish situation. And I thought that would be really valuable for everybody, for the landowners and also the investors. So they get a perspective on how it works and what we're offering. And
then we're going to have Darren on. And so we have ProFunds Mortgages, and Valor Capital is the development arm of ProFunds Mortgages, but we want to see how is the due diligence created, how is the underwriting, how do we be able to look at that. So that's very exciting. Looking forward to the show. And when we come back from the break, we'll take a break here in just a second, but when we come back, Carmen, I think it would be prudent just to talk to the everyday investors, the beloved viewers watching the show, just in terms of even how syndicate mortgages work and returns and all that kind of stuff.
Absolutely.
You're watching The Everyday Investor. We've got Carmen on the show. Very excited for this show. You don't want to miss it. The Everyday Investor continues in a moment. Thanks for watching. Whenever you're considering to invest in real estate, always ask the 4 questions to start. Number 1, what's the return on investment? Number 2, when do I get that money along with the money that I put in? Number 3, what is the minimum cash amount needed? And number 4, what is the risk in the worst case scenario? Hey, it's Rav. You're watching The Everyday Investor. I'm with my good friend, Carmen Capranero. We're talking about how to make money investing in mortgages. We can use registered money, meaning our ESPs, RSPs, LIRA, TFSA, all that kind of good stuff. We can use cash money. Carmen, it's a very interesting. I used to invest in mortgages. I take mom's money and invest in mortgages. And a lot of people don't necessarily know that you can do that.
Yes.
And what I love about investing in mortgages is there's no accreditations that are involved. You know, I do a lot of work in the land development side, and that's governed by the government, I guess, the Ontario Securities Commission. And
yes.
So there's certain income levels that you need to achieve, and but when you invest in mortgages, anybody can invest. There's not a lot of qualifications. We talk about 2 types of investments: private mortgages, and group mortgages or syndicate mortgages. Can you kind of define both of them?
Sure.
And the first question that we always ask is, what kind of return on investment could I see with that? So just touch on defining private mortgages versus group, and then what kind of returns somebody could see on average.
Okay, so private mortgages, individual. We call them individual
mortgages. Okay.
So that means one party would be lending to another. So with our company,
let's use me and you as an example.
Yeah.
So Rav needs some money to do something to a property.
Right.
Okay.
So Rav would come to ProFunds and say, ProFunds, I need a mortgage on this property.
Yeah.
And then we would have our underwriting team go in and do our analysis on it to see how your credit is, what do you need the money for, let's see your appraisals, and we underwrite it so we know it's a safe investment for our investors.
So underwriting means just simply due diligence
and qualifying.
And qualifying Rav.
Yes.
And seeing that, yes, I need to borrow. What's an average investment in individual mortgages?
Let's say $50,000.
Rav needs to borrow $50,000 because I've got a property over here. I want to do more than lipstick.
Yes.
When I renovate that thing, I'll refinance it. I'm paying back that person plus interest.
Yes.
And I'm making a lot of money at the same time. So Rav wants $50,000. So Carmen and her team at ProFunds Mortgages has to do some sort of due diligence on me to make sure there's some collateral that I'm definitely going to pay this money back.
Yes, we're going to ensure that it's from our perspective, a secure mortgage investment.
Okay.
So then what we do is we'll put it out to our clients, the investors that we work with, and we offer this opportunity. And we'll say, okay, this is the rate, which would be anywhere between, let's say, as a first mortgage, 7 and 10%.
Yeah.
And as a second mortgage, anywhere between 10 and 14% typically.
Okay,
and
so-
that's interest
So
only.
first mortgage, this house is worth $300,000. If there's no mortgage on it, then obviously it's very safe. Somebody's gonna give me $50,000.
Oh, that'd be amazing.
And because it's very safe, I'm only gonna pay out about 7%.
Yes.
But if there's already one of the big banks on there, or there's already a mortgage on there,
Yes.
Even from Pro Funds, and somebody's gonna lend me another 50 behind it, then I'm going to have to pay a little bit more. And you said where? Up to
14%.
Up to 14%.
Sometimes we see a little higher, but for the most part, we want to be fair to the people borrowing, yourself.
That's right, yeah.
So it makes sense for you. And then we also want to make sure that it's good for the investors that are involved.
And we all know, if you've been in this game for a while, Rav, could make 40, 50, 60% on that $50,000.
Right.
So I don't mind paying 14% if I'm going to make 50,
Right.
60%.
And the majority of our deals that come through our office are geared to investors. We don't really have problematic scenarios. So a lot of companies out there, they service people that are looking to consolidate, or they're in trouble, they're going to lose their home. That's not our appetite at all.
Yeah.
We prefer to deal with people that are, looking as an investment vehicle, of some sort, right?
Okay.
And they banks won't finance half the stuff today, and that's why there's such a demand. And we have good credit people that are worthy of that second mortgage, and it's secure.
So the everyday investor is going to is one of your clients,
Yes.
and they're going to lend this money to Rav.
Yeah.
Now, does the everyday investor and Rav, do we need to meet, or that's what Pro Funds is for?
Yeah.
They're the middle person, the broker.
We're the
if
broker.
You will, that's going to handle all this for both parties.
Yeah, so we do the due diligence on the file. We'll send it out to our investors. The investor, if they like it, they can ask any questions. If they want another appraisal, if they want this, if they want that. Mind you, it's got to be reasonable because we have to close on a certain level of time frame. But we'll draft all the paperwork. And everything is closed through a lawyer, so none of the funds will come to us.
Okay.
It always goes to a lawyer. They can have their own lawyer, and then the lawyer prepares the closing, does title searches, making sure that the property has clear title, so there's no issues. They register the charge on the property in exchange for the funds, and then the mortgage payments start, and they're usually paid monthly. And
Paid monthly, and those returns, so the everyday investor puts a charge on Rav's property. Rav pays for all those fees, the legal fees, and so on and so forth.
So it doesn't cost the investor anything.
The investor anything, and that investor is going to enjoy a annualized return of 7 to 14%, 1 year term, 2 year term, whatever we decide, paid monthly, paid quarterly, paid up.
Sometimes we get it in advance, right? So they can take advantage of getting all the interest in advance.
Yeah.
So that's basically how the individual mortgages go. That's what we call it, individual.
Fantastic.
Now, group mortgages or syndicated mortgages, what the industry is known for.
Yeah. It's Rav the builder.
Yes.
Rav the builder needs to borrow money.
Right.
And what is Rav the builder borrowing that money for? With the individual mortgage, Rav was going to do more than lipstick. He was going to do a full reno, make a basement suite, turn the single into a triplex. What's Rav the builder, Rav the developer borrowing that money?
Okay, so I will go to that in a minute, and I will say that syndicated mortgages are not exclusively to builders.
Oh.
We may have an individual, let's say for yourself, you have an apartment building, and you need about $1.5 million to close on the building because you got a great deal, and you need $500,000 to renovate.
Got it.
We will put out that as well, and that's called a syndicated mortgage. That means there's 10 or 15 people doing that 1.5 million.
Thank you for that clarification. So syndicate mortgages just means that there's more than one person lending to Rav the whatever, just Rav.
Yeah, investor
so
Rav.
When a group of people lend to Rav, that's called a syndicate mortgage.
That's right. So it doesn't have to be necessarily affiliated to a project.
Got it.
We also do offer that type of financing, though.
Yeah.
And we're very...
so, for example, Matthew's coming on the show.
Yes.
And he's a developer, per se. And he owns this property.
Yep.
And he could hold it, rezone it, flip it, make a lot of money. Or hold, the raw land, rezone it for building, and now build on it and even enjoy more profits.
Yeah.
And I guess that's what we're going to be talking about.
That's what we're going to be talking about. So the process there is, and I'll just make it very quick, is the deal will come in. So Matthew will come into the office, show us his opportunity. Our team of analysts will go through the deal, making sure that it makes sense, it's feasible, will it sell, all of that. And we spend quite a bit of time on that, and you'll meet Darren about that side of it. Once we do approve the deal, we put together something called a mortgage investment offering, which is a very detailed package on the deal.
A MIO.
A MIO.
MIO, mortgage
Yes.
investment offering, yeah?
Correct. It's called a
So
MIO.
very detailed.
Yes.
To the everyday investor.
Yes, and we do appraisals, and we're very, very thorough with our due diligence. So we're not just going to finance a deal on someone's word.
Yeah.
We want to make sure 100% that everything's in order.
Yeah.
And because we don't want to end up with a deal that's bad, because at the end of the day, then our investors will, and that's,
Sure.
no way that's going to happen. So that's a very critical point for us. So we'll go through that. They'll put a MIO together, and then we offer the investment to our investors. And this gives investors the ability to get involved in these really amazing projects that we have.
Yeah.
And we've paid out a few, and we've got many going. So it's very exciting.
And so for these investments, typically, okay, so the first answer was, what's the return on my investment? Well, the return on investment for an individual mortgage can be anywhere from 17 to 14%.
Mm-hmm. 7 to 14.
What did I say?
17.
Sorry. 7 to 14%. For a group mortgage, syndicate mortgage, the returns could be?
They're typically in the range of 12 to 14%. Some have been 16.
Yeah. But generally speaking, 12 to 14%.
12 to 14%.
Okay.
And they're fixed returns. So when we offer returns to our investors, it's not you're only making 7 or 8% now, and you might get the extra 4% later.
There's a legal
this
contract.
is fixed.
Yeah.
We're probably about the best paying group out there that does this type of investments for mortgages.
Yeah.
We offer the highest returns, and they're fixed.
Fixed returns, and there's no qualifications. The first question is what's the returns? Second question, when do we get that? Well, on an individual, the term could be 1 year to
1 year to 2 max.
Usually, for a syndicate mortgage, a group mortgage, the terms are?
They are 1 to 3 years.
1 to 3 years.
Yes.
But I'm still paid monthly.
You're paid monthly, or you have a choice with our company. We typically have an interest reserve on our projects, so you can take the whole investment up front. That means you're making interest on your interest.
Yes.
So people
nice.
take that money up front and reinvest it in another project, and they're being paid interest on that money.
Cool.
It's amazing.
And we don't have to use cash money. We can use registered funds to do this.
Yes. Now, registered funds they're a lot more time consuming.
Yeah, so we only do it maybe on bigger projects?
Yeah, on larger projects that have a lot of lead time. So cash or RSPs, TFSAs, LIRA, RIFs, but they have to be through a company we work with, which is Community Trust.
Community Trust.
So you have to have your funds in that vehicle.
Okay, but I mean, you help with the process to do that, right?
Oh yeah,
so
we'll help people, definitely. We guide you through that.
Let's say somebody had RSPs at, wherever they has a custodian that holds it, those RSPs needs to go to a different person who's holding it, custodian, happens to be Community Trust.
They're in Toronto, they're in Mississauga, they're local.
Then Community Trust points that money to the projects, and I make my returns, and it goes right back into the register. I'm not getting taxed on anything, it's going right back in.
Right.
And I'm growing my registered plan.
Yes, exactly.
Okay.
It's amazing.
Yeah, very cool. And so we've had some projects that have exited, meaning that people have gotten their returns and their principal back, and we have some ongoing projects right now.
Correct.
And are all the projects, and so I think it's also important to ask, this is not a fund, this is not like what we call a MIC, a mortgage investment corporation.
Yes.
If I'm an investor and I want to invest my money and lend it to somebody, it's project specific. I get to choose.
Absolutely, and that's such a good point, because so many people are confused with how it works. They think they're giving the money to our company. The money is always directed directly to the lawyer. So funds do not come to our company.
Yeah.
It is always, and it's your decision on what one you want to do. If you're not comfortable with one of the deals that we're presenting, you can wait for the next one.
Okay.
We have a huge demand. I think there's, a lot of people are finding out about this investment vehicle, and they're really comfortable with it and knowing the due diligence behind the scenes. So we have such a demand for these investments, so they fill up very quickly.
Well, sure. I mean, if you're making, 8, 7, 14% cash flowing, and
registered on real
money,
estate,
cash money registered on real estate, I can see how that.
And there's no qualification, so you don't have to be an accredited investor to get involved.
Yeah.
Now, we also want to know our client, so we have a know your client process where we know what your situation is, because we don't want somebody coming in with their last $50,000, right?
No,
so we want to make sure that people are okay with it, and that it can, and with mortgage investing, and I want to make this comment because a lot of people think it's like a bond or a GIC, and if there's an exact payout date, that's what it is. With mortgage lending, you have to have flexibility on the closing time and the payout time. Now, it would be, let's say we say it's a year term.
Yeah.
Maybe we're doing a refinance with an institution, and the institution is asking for all these extra things.
Yeah.
Or maybe they're really busy.
So it's 13 months. Or
so it might be 13, it might be 14, it might be 15, but you know what? You're getting paid your interest until the very day you get your money back.
Yeah.
But you have to have some flexibility. So if you're lending your money into a mortgage investment, don't allocate it elsewhere.
You are a wise woman. Thank you, Carmen, for being on the show. Talking to Carmen Caponero, we're learning how to make money investing in mortgages. When we come back, we have Sean Matthew Fredericks on the show, and we're going to be talking about his piece of property and what he's thinking about doing to that. The Everyday Investor continues in a moment. Did you know that you typically cannot lend your RSPs as a mortgage on your own property? Most registered plan holders will require a mortgage investment to be arm's length, meaning a third-party investor, according to CRA guidelines. Hey, it's Rav. Welcome back to the Everyday Investor. We're talking about investing in mortgages, how you can make money, investing in mortgages, individual mortgages, group mortgages, otherwise known as syndicate mortgages. But we're also talking about, and to landowners. If you have a piece of land and what you can do with it, a lot of times we would buy land and we would hope for it to get rezoned, and then we would perhaps maybe sell it to a developer. But why not become the developer yourself? I have a friend on the show. He's an investor. He's a teacher, a coach. Invested really all over the place, internationally, down south, places like Belize, up here, out west, in Toronto, all that kind of good stuff. Sean Matthew Fredericks on the show. I know him as Matthew Fredericks. Matthew, thanks so much for being here, my friend. It's been a while. I think you came on the show maybe 4 or 5 years ago, and you were telling me because you're always doing tons of research. I know your brother and even mother are kind of in the game as well, real estate investing game. And you were teaching me about crown land that the government owned, doing things, which was very cool, with the native people of Canada. And there's always such, a lot of really cool stuff that's going on, and you've owned land all over the place. And you've shared with me that in reconnecting your friendship with, not that I was ever gone, but getting reacquainted with Carmen, there's some other things some options that have come into play here in terms of development. But before we get into that, talk to the viewers at home a little bit about your story and how you got involved in the different kinds of things you've done in your real estate experience.
Well, Rav, I started in real estate probably 25, 26 years ago. Yeah. And I initially bought a house. My brother came to me and said to me, you should invest with me. I'm like, I'm a teacher. I'm not an investor. He says, I'm a cop. I'm going to tell you what to do. I'm your older brother. I want you to follow me. Yeah. So, you know what? I said, why not? And my concept back then was simple. Buy one extra property and hold it for 22 years. It'll be my nest egg. Yeah. You know what? But 6 months later, I got into a better situation where I bought a second property that I considered my legacy property. If I had kids in the future, I'd probably hold that.
And it's very interesting that you say that, because we encourage everyone to at least have an investment property. It's not a big deal. A lot of people are apprehensive. You were what? I mean, you're in your late teens, 20?
I was like 22.
And what I heard you say is you bought the property and it was boring. You're making money and it was boring, right. So then you bought another one. Okay, so continue.
Exactly. And then I bought a third one, more for a rainy day. Yeah. But back then, I had the opportunity to do that. I didn't have kids. I had a job that was teaching. It didn't mean I have to wake up 2 a.m. in the morning and go fix a database somewhere. So I had that opportunity. Yeah. Today, if I were to do it again, it would be a little bit different. I wouldn't have that time, so I'd probably invest with other people as opposed to doing everything from scratch and doing everything by myself. Yeah. So it was a great start. And because I'm a curious person, I decided to learn all the strategies. And I've always tried to do different strategies. learned them. Sometimes I fail at a few.
Yeah.
I succeeded at others, but I think both really
It's
help.
not failure, it's education.
Exactly.
And I'm glad that you just said the different strategies, because what we try to do on this show for the everyday investor at home is to really talk about, it's not just buying a house, tenanting it out, and holding it.
That's right.
That's a very simple, basic, and very good strategy that both you and I have made some money doing.
That's right.
But there's so many other strategies, whether they're real estate investment trusts, whether there's mortgage investment corporations, whether they're in land development. What we're talking about here, which is really fascinating and quite easy and simple to understand, investing in mortgages.
That's right.
And there's just different opportunities. So I'm glad that you brought that up. You've done them all,
yes.
And now you're endeavoring on something else. So continue.
Yeah, so my natural progression just happened to have moved from residential to commercial. But in 2009, I thought, I want to do something different. I want to learn new things. And I thought, I'll partner with some developers out west, and I did. We've built over 240 houses. So I understand the process.
Yeah.
Now, recently I reconnected with Carm, and I'm sitting here thinking, wait a second, I have a nugget. I have property that's sitting there, land, that I can do something with. And there's so many people today that are sitting on something simple, a piece of land. Maybe it's in the family for a period of time. Maybe it's a property they have with a building and some land.
Yeah.
That land's not being used.
Yeah.
And after sitting with Carmen, talking about what Valor does, I thought, what, this is fantastic. I don't have to have my team of developers here in Ontario. I can actually work with a group of people who know what they're doing.
Yeah.
And win with a team, which I think is really important.
So for those that are landowners that are watching,
yes.
This is what we're asking them to think about, is that it can be a piece of land, and it actually could be an income-producing piece of land.
Exactly.
But it may not be to the highest and best use.
Exactly.
And so therefore, why not get rid of that and develop something to the highest and best use, refinance it, sell it, all that kind of good stuff.
In my situation, I have an income-producing property. I have 1.5 acres sitting off to the side, not doing anything. I saw it as one lump. But really, after sitting there and talking to Carm, I thought, wait a second, I have that piece of land. Why not do something with it? Makes life even easier because I have an income-producing property along the way. But again, the important part was, finding a group of people that can actually walk through the process. Now, today I have an 8-year-old daughter. She's very important to me. You know what? A priority in my life.
Yeah.
Do I want to go out there and actually build and spend 80 hours a week working on something that it's going to bring great financial return, at the same time, taken away from things that matter most?
No price we can put to our time.
That's right.
Right? And so let's talk about it. So I'm not sure if there's some legalities in terms of full disclosure. But kind of broad strokes, what are we now doing? So you have a piece of land, you're saying it's 1.5 acres?
Yeah, so it's actually 2.1 acre.
2.1
and
acre,
there is a building on there right now, 7,000 square foot building.
Okay.
There's a 1.2, 1.5 acres off to the side. And I'm sitting down with Pro Funds and Valor Capital. And now we're walking through the process of, is it feasible? So I have a team of builders who sit down, people who analyze with me, and we're going through the process to see, will it make money? Does it make sense? Does it make sense to the investor? At the same time, what are all the problems that can go wrong? How can we deal with those up front? And what can we put together? So I'm at the early stage of just assembling that right now. And I'm pretty excited about it.
Yeah, no, it sounds very exciting. And again, you've been in the business, almost 3 decades. You've invested in all sorts of things. Talk a little bit about this compared to the rest, developing land. This compared to all the other things. I mean, this really is the biggest margin, correct me if I'm wrong, but it can be the biggest margin, in terms of income that one could make.
It is.
Would you agree? And why is that the case?
Yeah, so I agree. It's the biggest income. At the same time, if you have the wrong team and you don't do it right, it could be the biggest headache.
Yeah.
That's why it's important to have people that are on your team who've been doing this for 15 years, 10 years, along the way. You can buy a building. You buy a building, that's great. You spend 2 years making that building more efficient, more effective. By the 3rd year, you want to refinance it, take some money back out, and probably hold it for about 7.5 years. So there's money in a building, and there's tenants to deal with. But with land, you find it, you pretty much secure it. If you've had it in your family for a period of time, that's incredible because some equity has built up, value has built up. You spent some time raising money for it. That's the part I love about Valor. I don't have to raise money. They are great at raising money. That eliminates the biggest headache that I have.
Sure.
You know, to raise money for it. And then the second part is to go through all the feasibility studies along the way. So when that is taken care of, all of a sudden once we build, the profits on the back end are pretty tremendous. And what I like about Valor is we have the same way of thinking. We don't build huge. I like to build simple, a 4-story, a 6-story.
Sure.
I'd like to build something that's within 2 years, maybe 3 years. So it's doable, so that it's not 1,000 units to sell. You may have 30, 40, 50 units to sell, and that's manageable. And some people have an issue with seeing 5 years. Like the horizon for most are 3 years. So a lot of people would like to see something done in 3 years, build confidence with that company, and then say, hey, you know what, 3 years, I've got my money back. Why not just do it again? So a great plan would be, instead of buying what I did back then, you buy 1 house, 2 house, 3 house, would be to find a great company, invest in a syndication, build a relationship for 2-3 years, and then look at the situation. Was it good? And then you just keep doing that again and again and again, especially when you're in a certain age range.
Sure.
I'm not 21 anymore.
But
So
you look at 20,
I
maybe,
feel
maybe,
it, but
maybe
I'm
22.
not.
So talk to me a little bit about, because you spent a lot of time out west and you were doing a lot of real estate out there and you've been in different places. Talk a little bit about the economics of doing something like this in Ontario as opposed to other parts of Canada, as opposed to the States, and even maybe down south. What are your thoughts there?
Well, what's great about out west, it's resource-based, but that's also a problem. I mean, you can't take a resource out of the country in a sense. You can't ship jobs elsewhere. But the fact is, as we see right now, when I started building, oil prices were $1.18 a barrel. Today they're $45.73 a barrel. That's a problem. Ontario has always been a stable place. It's a place where the population is growing. People want to come out here. They want to do business here, and we can see what's happened in the last 10 or 15 years. So I'm grounded here. I'm happy to be back here. The market's growing. Great team. I think this is really the place to be.
And in the right place. I mean, there's also demand, right? There is
demand.
We can't keep up with building housing for people. So there's a demand here, whether it's in migration from people coming in from other parts of Canada, whether it's foreigners that are coming in. Thoughts in and around that. I mean, would you concur that there's a great economy here, and so then therefore lots of people are moving in. There's a demand for people to rent, to own, to buy.
I agree. I mean, I love Canada. I love the whole country. At the same time, people in other places always look at Toronto as the center of the country. And ultimately, people come here, and you know what? They love it. There's so much opportunity, so many things to do. A great place to live.
Talk a little bit on, you mentioned it before, and I think that's what Carmen and ProFunds is great at, about the brokering deals, like just the teamwork and how important, I mean, the biggest companies in the world, I think, probably Apple has the most partners out of anybody, right? I mean, the biggest companies in the world, everybody partners to be able to get a job done, and it's always a win-win. So talk about, that transition from you doing a lot of things on your own to being able to take investors' dollars, take it from them, invest it for them, give back. You win, they win. Of course, Carmen has kids that need to eat as well. We all win in this play, and everybody feels. So talk about that, about the importance of partnership.
Yeah, in the beginning, I did a lot of things by myself. It was really hard to find people who would buy into what I was doing. I was the oddball, the strange person, the person that we see that on television, but it can't really work.
So it's hard to cast vision.
It's really hard to do that.
You could be a visionary, but it's hard to cast that upon somebody else.
That's right. So I really had no choice but to work on my own. But what I realized after a while is I looked at all my deals and situations that I've gone through, and most of my successes come from when I work with other people. They fill in the gaps, which means I'm not perfect. There are areas that I lack, and they fill the gaps in to complete me as a person. And as a complete person, I think you're able to help other people even better. And if you can't swim, you shouldn't really be jumping in the water to save other people. So let's get ourselves into a situation where we can swim. And if you have, again, a great team around you that fills the gaps, which means they can analyze, they can build, they can cost a job the right way. And then at the same time, what I love about even Valor is that they sell the units for you. I mean, it's a one-stop shop.
They raise monies for you, they can sell for you, and you can do what you're good at doing.
So all the things I used to do out in Western Canada, where I had to do myself or with my team, they do it here for me.
Great to have you on the show. Thanks
Great to
for
be
being here. We're talking to Matthew Fredericks. If you're a landowner and you want some more information, contact him directly. Contact Carmen at ProFunds. Thanks for watching. We'll be right back. Did you know that all mortgage transactions are registered through a lawyer? Lawyers are involved to protect you, the investor, confirming clear title and that security is registered on the property. Hey, it's Rav. You're watching The Everyday Investor. We're talking about how to make money investing in mortgages, but we also had a short segment talking to Matthew Fredericks about if you're a landowner and how you can make money to the highest and best use of the land that you own. It was very interesting talking to him. If you missed the show at all, go to rogerstv.com. Make sure you see the repeats. It was a great little segment. Right now, I have Darren Nessio on the show. He is an analyst with Valor Capital. Darren, it's great to have you here, my friend.
Yeah, thanks a lot for having me, Rav.
Yeah, it's wonderful to have somebody who's it's not hard to do, but that's a lot smarter than me when it comes to numbers. You're kind of a financial analyst, taking a look at all the due diligence for something like Matthew when he came on the show. He owns a piece of land, and does this make sense to be able to develop on? Talk to me a little bit about the process of that. Then we hand it over to ProFunds. We've got all the investors, and everybody wins. So I'd love to know a lot about that. Prior to that, how did you get involved in this whole world of real estate and development, and with Valor and Carmen and all that kind of good stuff?
Yeah, so I went to school at University of Western Ontario and graduated with a background in finance.
Okay.
So I've always been interested in finance, always had numbers backgrounds. And then I started working for an insurance company. I loved the insurance company, it was great, but I didn't necessarily want to climb the corporate ladder there. Yeah. It wasn't as kind of exciting as real estate was for me.
Sure.
So I also had 2 student rentals at the time, and I knew that real estate was kind of a passion of mine. It always got me excited. So I wanted to get a job in real estate because I knew that's where I wanted to focus my attention, that's where I wanted to grow. And so
you were at Western in London, Ontario. You already had a couple of investment properties.
Yeah.
Your background was finance. Of course, we talk a lot about meaning, time in life and spending time with loved ones. But the other part that I really admire and that we should all go after is finding some sort of meaning in life as well. Mm-hmm. And so you're working for an insurance company. It was kind of a little monotonous for you.
Yeah.
And so you jumped over into the real estate side.
Yeah.
Okay.
And so much more exciting on this side. And I got hooked up with Carmen through a family friend of mine who had done business with Carmen in the past. And she brought me on, give me a chance, and it's been working out well ever since. Yeah.
Cool, very cool. And so so your job there at Valor, talk about even the relationship between Valor Capital and ProFunds Mortgages. How does that kind of work?
Yeah, so basically when a development deal such as Matthew's comes to the table at ProFunds, it usually goes directly to Valor.
Okay.
And so Valor is basically the sister company to ProFunds.
Yeah.
And so what we do is we do all the due diligence of these development projects, making sure they're feasible, going through market reports, doing our own internal valuations. So we're basically doing the whole due diligence of Matthew's project.
Okay.
And making sure that it's a safe, secure investment for our investors on the ProFund side.
So what is, take me down, a little deeper into that. What makes something feasible, Obviously, I would think it just can't be, grandma's raw land. It's probably got to be zoned to be able to build on, or almost ready to be zoned, and we know that the municipality, I mean, what are some of the things that you look at intricately?
Yeah, so every deal is different, so there's not a classic checklist that we go through, I guess you could say, because every deal is kind of structured in a different way, but we make sure we have...
So let's talk about Matthew's deal. For example, you know, not to divulge everything, but let's hypothetically, where's his land at in terms of being ready to build? What would we build on it? All, you know, kind of, let's pretend that was what you were looking at right now. Yeah.
So Matthew kind of brings all that information to us directly.
Okay.
So it would be a parcel of land, like he said, 2.1 acres.
Yep.
It's zoned for commercial, residential. So we know that the zoning's there for the build that, you know, Matthew's brought to us. So we're going to go over his build first and see if it's feasible, to see if it's feasible for both a construction cost side of things as well as the sales side of things.
Got it.
We got to make sure there's demand for that at the end of the day.
It's got to be profit.
Yeah,
okay.
Exactly. So we'll go through all of his costs, making sure that he's, you know, doing his own checklists and making sure that he's bringing viable costs and making sure that they're all have been checked.
Yeah.
Then from there, we're going to check, like you said, kind of like the survey of the property, making sure that we have the proper setback requirements for the proposed build. And then we'll also kind of bring our own suggestions about the build. There's a big team at Valor. I'm kind of just one person in the team. So basically we have construction managers, development consultants, and they've had 20, 30 years experience in the business. So they know what's cheapest to build or best to build for that type of scenario. And so they kind of help and give some suggestions as to the built form.
Okay, great. So when we look at it from an investment standpoint, you know, as Carmen was on, and she'll close out the show with me here in a few minutes, our returns can be anywhere from, you know, 7, 8 to 14, 15% on an annualized basis. When do I get that money? We talked about, you know, it might be a 2-year deal, a 3-year deal, but we're paid either up front, we're paid monthly, quarterly, yearly, all that kind of good stuff. Minimum investment could be as little as $25,000, could be registered money. But the fourth question, which is always important, is the risk. And so this is your area of expertise. What separates, I mean, you know, I've known Carmen, I've known, you know, people who have invested and exited and seen some great returns. And then I also read the headlines sometimes, and you know, so what are we looking for to mitigate risk? How do we mitigate? What's Valor's job in helping to mitigate risk? You know, Matthew, great guy, known him for many years, but you know, anybody can say, hey, here's a piece of land and here's what I think is going to happen. What are some of the things that we do to mitigate?
So the number one thing that we do is whenever someone like Matthew comes to the table and wants to develop a project, we partner with them directly. And so we make sure that we're involved in kind of every step. We're invested as a company into, say, that specific project. And we're making sure we know exactly where every dollar's going. We're making sure that we're getting the best quotes, the best prices. We're not getting gouged anywhere on some, you know, engineering costs or record of site condition costs, anything like that. So we're kind of controlling the flow of funds and making sure that, you know, we're on budget, we're on time, and so that's basically pretty much our risk management tool to ensure that the process is moving along and that there's a successful exit to the project.
You do all the appraisals.
We don't do them personally.
Third party.
Third party, exactly.
Yeah, so we have, but you're responsible for that being done. Appraisals, current value, future value.
Yes.
To be able to make sure that those things are there.
Yeah. So essentially, we're never going to release monies that are in excess of what that land is valued at today.
Okay.
So say if the land that Matthew has is hypothetically worth $3 million. We're not going to give him $4 million today.
Okay.
So what we're going to do is, we're going to maybe advance $2 million to the project. And then he's going to do some things to that land, you know, maybe get it ready for construction, go through his site plan application, and then all of a sudden that land is worth a little bit more. And then you're able to release some more funds. And so we kind of maintain that loan to value all the way throughout the construction process and development process.
And in that example, it's 66.6%, but generally speaking, we can, you know, kind of sit in around 70, 80%. I mean, if it's worth $3 million, obviously we don't lend out, $3 million or even more than that,
Yep.
we want to make sure that there's some margin there.
Yep.
For
A safety buffer.
Yeah, a safety buffer there.
Yeah.
Okay, great. So now we love what Matthew's suggesting, what we're going to build. Maybe it's a couple of low-rise apartment buildings, maybe 20 units each, or whatever the case. Maybe a little commercial in there as well, a little plaza. How does we like this? How does this now transfer over to Pro Funds, and then what happens from there? Because really, it's the everyday investor, right? We're
Yep.
talking to the viewers at home about how they can get involved and make some money. So how would that one work?
Yeah, exactly. So after Valor has done its due diligence on the project, and we kind of give it our green stamp of approval, and we're moving forward with it.
Yeah.
And I just want to say that we have projects come to the table all the time.
Yeah.
Like for every one of Matthew's, there might be 10 other deals that don't fit within our model, and we don't feel safe and secure with that investment.
Sure.
And we send them.
We want to take the best
Yeah.
ones.
So we take the best of the best,
Yeah.
and then after we've done that due diligence process and it moves along, it goes over to the Pro Fund side. And so then they're the ones who are going to bring that mortgage investment opportunity to the market, to the everyday investor.
Yeah.
And usually for project investments, it's a $50,000 minimum.
50,000, okay.
Yep. And you might get together a group of 50 people who come together with 50,000
Yeah.
to make 2.5 million
Yeah.
to fund Matthew's deal.
Okay.
And so they're the ones kind of making sure that they do all the paperwork to help the investors with all the disclosures, and making sure that they streamline the process and make it as easy as possible. They're the ones contacting the lawyers, making sure that the lawyers are comfortable, and we provide all the due diligence materials to the lawyers.
Yeah.
So the lawyers have to make sure they're comfortable as well with the investment.
So Matthew brings a deal, a landowner brings a deal, there might be something on it, maybe not. We're looking at the highest and best use of it. Valor helps out with and verifies and does all the due diligence there. Valor likes it. Valor invests with Matthew. They partner together. We send it over to Pro Funds. Pro Funds finds they're already there waiting for the deals, the investor base to be able to put forth the monies and invest and enjoy a return on that. And Pro Funds is going to see this throughout till exit, right? Pro Funds is going to be able to see this out till exit as they represent the client. And so, what's the governing body? Is there a whether somebody's doing a MIC or a REIT or some sort of land development, if you will. A lot of times it falls under the Ontario Securities Commission, and there's lots of regulations. Mortgages they don't fall under that. What would they fall under? And
So
how's that?
yeah, they fall under FISCO.
Fiscal.
Yeah.
Okay.
So that's for Ontario. So each province has their own different regulatory body.
Yeah.
So it's different from the OSC, and it's not as stringent, because the way they view mortgage investments is it's a little bit more secure, because you're directly registered on title for that property.
Okay.
So you're kind of first of priority of payments. Equity comes in behind you, so it kind of gives you a little bit more security, and therefore the government of Canada and Ontario have taken the stance that it can be governed under the body of FISCO. So therefore, there's none.
Fiscal's just the financial services arm of
Commission of Ontario, I believe.
Yeah. So
Don't quote me on
they're
that.
the ones that kind of look at all the outfits like Pro Funds and make sure that not that we wouldn't do it in house, but there's a lot of security for the investor to make sure that the I's are dotted, T's are crossed.
Yeah. No, exactly. So,
Okay.
yeah.
Very cool, man. I mean, it's great to. I'm glad Carmen brought you on, because we look at it from different vantage points. I get to look at it from Valor's vantage point and what they're doing and their due diligence. We get to look at it from Matthew's vantage point as a landowner, and then of course what we always talk about, and I think it's the most important, is the investors, the investors at home. So thanks, Darren, so much. For
thanks
being,
a lot, Rav.
for being on the show. I'd love to have you back
Yeah.
sometime.
Thank you.
We've been talking to Darren. We've been talking about developing, mortgage investing, all that kind of good stuff. Carmen Campanaro will be back with her closing thoughts. Don't go anywhere. If you have any questions pertaining to this show, or there's a topic that you would like covered, please visit www.rogerstv.com. That was great. Hey, it's Rav. Welcome back to The Everyday Investor. We've had a fantastic show talking to my guest today, talking about mortgage investing, a little bit about land development, talking a little bit about how you assess it to make sure that it's a great opportunity. Carmen, thank you so much for really putting the show together and talking about the world of investments, specifically in mortgages and land development. What would you say to the viewers at home that are watching? Just kind of closing thoughts, giving a kind of a maternal view, a protecting view of to the viewers at home. Yeah.
Well, I would say, a lot of people are overwhelmed easily.
Yeah.
It's not as difficult. It's not as challenging. And when you have a really solid team behind you, I guess when you get involved in these types of investments, it's good to know who's behind the scenes, who's running the operation, and their success rate and their history would be really key for people. But it's really not that complicated or difficult. It's very easy, very passive. You could have a full-time job and 10 children at home and still do this and earn a great return. Yeah. So it's good for everybody, really.
Yeah, I mean, and where we put our money today, if you're not happy with the returns, I mean, there's other places to invest, such as investing in mortgages, where we can make some
conservative mortgage investments too.
Yes.
So you can do first mortgages at 50% loan to value and still make 8% or 7% on your money, which is far better what you're getting anywhere else out there right now.
Fantastic.
I mean, GICs and all that stuff. So it's great.
Well, listen, I always love learning from you. And very, very grateful that you actually sponsored the show, that you believe in, everyday investors. You believe in people. It's how you've gotten started. I applaud you. I was raised by a single mom. I'm always inspired that you as a single mom are so successful. So thank you so much for being on the show, and I can't wait till you're on again.
Okay, thanks, Rav.
Thank you so much. On behalf of Rogers TV and myself, Rav Toor, we'll see you next week, same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.